Hello, everyone. Welcome to our show for April the 19th. As you can see, we're not in our usual places compared to where we'd normally be on a Tuesday morning. Ned and I are traveling. We also have a special guest today. Dan Deegan's joining us all the way from the Dominican Republic. Dan would normally be in Toronto or in Ontario, thereabouts. Dan, welcome to the show. All good, Ned, on your end? Safe travels in?
Yeah, no real concerns. It's weird
Yeah.
being on a plane again, but
I know. Yeah, mask mandate was lifted, looks like overnight. Ken, I'm in for Ken this week. He was traveling this morning out of Cleveland. He said there was a blizzard there this morning, so we've got some crazy April weather. But Dan, it sounds like you're on vacation and the birds are chirping. Talk to us about where you are.
Yeah, it was. We hadn't been on a plane in over 2 years, in just over 2 years now.
Right.
And I can tell you, patience was a virtue, and it was. I guess people were just streaming out. There was this one guy that was behind us, and we're moving up in line, and I guess there was an extra 3 feet in front of us between the person in front. He's like, there's two lines, get going, and kind of turned around, looked at him, and went like, we're getting on the same plane, right? That's not taking off before everyone's on it. And it was kind of interesting because we get off at the resort and he's like two people in front of us. And it's, you kind of look at it. It's teaching you patience. It's teaching you patience. I can tell you, the whole mask on a plane sucks. Hard. It's just like, I feel like you feel like you're over here. I don't know how people in restaurants and all this, I mean, maybe a little bit different in some areas of the US, but I know in Ontario, like we just had our mask mandates lifted, but for the last 2 years, people working daily with a mask on.
Yeah,
I mean, for sure.
All right. Well, let's get the show started. As you all know, we're here Tuesdays, 10 a.m. Eastern. You can catch us also later on YouTube if you're unable to get to the show. Just search for DAT Freight and Analytics. As always, the show's here primarily for your benefit. Make sure you get your questions into the chat section, get them in early. We'll get to them towards the end of the show once we bring Dan back to talk more about what he does in Canada, and in particular, what's going on in the Canadian freight market, because the recent border protests last week will add more capacity shortages, I think, for loads north. So let's have a look at some of the freight trends we're watching. Dry van and reefer spot rates continue to head south last week. They've been dropping at about a rate of 6 cents per week. Flatbed's holding just shy of its record highs, though. So flatbed is one of the stars of the show this year. On the load-to-truck ratio section, van and reefer are back to 2018 levels, while equipment posts are sitting around 2019 and 2020 levels. And if you remember, in April of both of those years, that's when capacity loosened more so in 2020 at the start of the pandemic. Southern border spot rates are up. We'll cover that a little bit later in the show. And of course, one of the latest wrinkles in the global supply chain shortage is the neon shortage that's expected to further impact semiconductor chip shortage for truck, trailer and spare parts manufacturers. Neon is required for lasers that are used in chip production. And it turns out more than half of the world's production is in the Ukraine. Just a handful of companies, 2 of the 3 companies that make neon are closed down at the moment. The winter salad bowl is closed down. Big companies like Church Brothers Farms are moving their entire operation back to Salinas. So we'll see some decreasing in rates and volume out of there for lettuce production. There's also a great video on YouTube of Church Brothers Farms moving their entire salad production plant on 60 flatbed trailers from Salinas to Houma and then back again. They do it twice a year. It's quite the logistical feat. We've also got some interesting data out. If you're following Professor Jason Miller from MSU, make sure you do this week. He's got some great data. His retail truck tonnage index was down 3.2%. That's year over year in March, but up 17.5% compared to 2019. So even though retail demand is slower, it's still very elevated, especially for flatbed carriers. Industrial production for machinery numbers came in at the highest level since 2014. And following the recent housing boom, household appliances are at their highest level in recorded history. I'm sure that's no surprise to anybody. Let's jump into our weekly update. Load to truck ratio, dry van load post volumes are about 30% lower than this time last year, but higher by the same amount compared to 2018. For context, the rapid loosening of capacity resulting in equipment posts back to 1920 levels is of more concern, though. Last week, the dry van load-to-truck ratio dropped another 11% to 3.02. That's about the same level as it was this time in 2018. In the refrigerated sector, spot rates, load-to-truck ratio was about the same movement last week. Having a look at the flatbed load-to-truck ratio, they dropped by about 6% last week. They're down about 26% in the previous 4 weeks. There was very little change in carrier equipment posts last week. The flatbed load-to-truck ratio, the reefer load-to-truck ratio moved down slightly. The flatbed ended about 58.73. That's about 39% lower than this time last year, and about 39% lower than the booming flatbed market in 2018. Having looked at our market condition index, we're focusing a little bit on port markets this week. South Carolina ports just recorded their all-time high container record movement in March. That's the 13th month of cargo records at the Port of Charleston. The coastal shift of import volumes continues from west to east. But right at this juncture, South Carolina shippers are finding plenty of capacity. In the Charleston market, rates dropped 4 cents a mile last week to an average outbound rate of $2.45. That's down 21 cents a mile in the previous month. On the short-haul lane to Atlanta, where a lot of volume moves out of Charleston, capacity also loosened. Rates dropped by 38 cents a mile since March to an average of $2.93 this week. That's about exactly where rates were this time last year on that lane. Having a look at the West Coast, volumes of loads moving between Los Angeles and Chicago dropped 11% last week. Dry van rates plunged even further, and they're currently at an average of $1.93. Spot rates on this 2,000-mile lane are now 48 cents a mile lower than the previous year, and down an impressive $1.36 a mile since the peak of $3.29 last December. So capacity is loosening rapidly on the West Coast for dry van. We talked about the protests on the southern border following the introduction of additional screening of every northbound truck last week. Even though some of those restrictions have been lifted, spot rates did go up by about 30 cents a mile along the southern border to an average of $2.10. For loads between Laredo and Los Angeles. Loads east to Atlanta were up slightly, only up 4 cents a mile to an average of $2.66, but we expect more volatility to come this week as that market struggles to get back to normal. Having a look at the refrigeration sector, there's a pretty bad drought going on in California, although some of the storms this week may provide some respite. It's a pretty gloomy outlook for farmers. This impacts produce season. Water shortages are extensive. But carriers are finding higher spot rates this week in Fresno as produce season starts to get going. Rates up 5 cents a mile to $2.30. They've been dropping for the 3 weeks prior. Fresno to Boston up 27% or 13 cents a mile to an average of $2.19. Rates on this lane typically trend upwards from now until July, but we're starting the produce season around 50 cents a mile lower than this time last year. Another big lane for produce out of the West Coast is Fresno to Hunts Point, New York. Loads were up about 13 cents a mile last week to an average of $2.13. Loads north to Seattle were down by 2%. That's loads being moved. So spot rates kept flat this week at $3.49. Just having a look at the overall Southern California market, capacity has been loosening for the last month, but showing signs this week of reversing course. Rates in the entire Southern California region went up about a penny per mile last week. Even spot rates for loads from Los Angeles to Las Vegas were up last week, up by 18 cents a mile to an average of $5.14. That's excluding fuel. They've dropped by just over $1 a mile since the start of the year. So some signs of life in the produce market on the West Coast. On the East Coast, though, reefer capacity continues to loosen. One of the busier lanes in the DAT network is Atlanta to Orlando. Rates dropped 40 cents a mile in the last 4 weeks to $3.43 and are now 14 cents a mile lower year over year. Having a look at flatbed, capacity and demand were flat last week for loads between Los Angeles and Phoenix. It's quite a busy lane for flatbedders. Spot rates stayed around 392. Number of loads being moved on our network remained at the same level as the week prior. In the overall Los Angeles flatbed market, spot rates were also flat, stayed around an average of $2.71 a mile to all destinations. South San Diego was a busier market last week. Even though it's smaller, capacity was very tight. Spot rates jumped 32 cents a mile to an average of $2.69. A lot of steel comes into that market, so we're seeing a lot of volume move out of there. One of the volume lanes that we looked at in San Diego last week, 1,500 miles east to Houston, rates jumped 90 cents a mile to an average of 263 last week, while capacity loosened on loads north to Salt Lake City, dropping 30 cents a mile to 271. One of our biggest markets for flatbed volume is Houston. That market continues to tighten after several weeks of decreasing. We're seeing rates up 4 cents a mile last week to an average of 298. And on the number one lane, that's the busiest lane for flatbeds in our network, Houston to Fort Worth, the number of loads being moved decreased 2% last week, but capacity tightened, pushing spot rates up to a new 12-month high of 381. That's about $1 per mile higher than this time last year. So wrapping up our market update with our year-over-year look at spot rates, dry van dropped another 6 cents per mile last week, already down by as much again this week, but down 6 cents a mile last week to a national average of 222. That's excluding fuel. They've been dropping by about the same amount for the last month. They're now down 56 cents a mile since the start of the year and are about 33 cents a mile higher than this time last year, for context on that last big market we had back in 18. Spot rates in refrigerated down by 66 cents a mile since the start of the year, down 5 cents a mile last week, down by slightly more than that this week. They're now down around 10 cents a mile lower than this time last year. Average rate last week was 251. But as you can see from the chart, reefer spot rates are still 37 cents a mile higher than 2018 and almost 70 cents a mile higher than the same time in the previous 4 non-pandemic years from 16 to 19. And lastly, in flatbed, for the last 2 months, flatbed rates have averaged around 270 a mile. That's precisely where they ended last week at following a 2 cent per mile decrease. They're still about 6% or 15 cents a mile higher than the previous year. And compared to the 2018 bull market, flatbed spot rates are now 38 cents a mile higher than the same week that year. We're also about 5 cents a mile off the record high set in June last year in flatbed, but we're seeing some resistance for rates to go much further. So that's it for this week's market update. Remember, if you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published on Wednesday evening. And with that, it's over to Ned for the short-term forecast.
Hello, everybody. Before we get into the details of the short-term forecast, I want to remind people to get your questions in early. We will be taking listener questions later in the show. And so if you have a question that you want to ask, please get it in. Sooner is better than later. Now on to the charts. A little grim, but we'll keep a brave face. In blue, you can see the historical rates, the market rates observed by DAT. And then off to the right, you can see our various forecasts. Ratecast is expecting that the current trend will break in about a week or two and then head out flat past that, stabilizing at around 210 a mile, 215 a mile if my eyes are doing their job. In contrast, the short-term model is expecting the current slide to continue into the near future, ending in the middle of May at about 190 a mile. So a considerable drop left if the short-term model is to be believed. The blended forecasts in gold and silver, which are mixtures of these two forecasts in different amounts and in different ways, are leaning a little bit more towards the short-term forecast, although there's some slowing of the rate of drop once we get into the early part of May. Moving on next to reefer. Once again, in blue, you can see the market rates observed by DAT. And then Ratecast is expecting that as produce season picks up, rates will stabilize and then lift themselves back up, dropping by about 5 cents, but then gaining back 7 cents as we move into the middle part of May. If you're a little bit more pessimistic, the short-term model is expecting current drops to continue and maybe even accelerate slightly, ending at about 205 a mile by the middle part of May. And that short term is in red. The gold and silver are blended forecasts, which are mixtures of the two forecasts in different amounts and in different ways. They're leaning much more, again, towards the short-term model, although once more, the rate of drop is stabilizing with them ending around 220 a mile, I believe, as we move into the middle part of May. Finally, in flatbed, we have much less dramatic charts that make me a lot happier. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our various forecasts. Ratecast in green is expecting rates to drop by maybe a couple of pennies and then pick up, gaining about 5 cents once we hit May and we move into the summer building season. In red is our short-term forecast. which expects rates to drop slowly, losing about 2 or 3 cents over the next month. And then our gold and silver blended forecasts are splitting the difference, maybe leaning a little bit more towards short term, with the line at a more or less flat level, maybe gaining a penny or two over the next period. And with that, we're through to forecasts and on to our DAT IQ question of the week, which is,
Right.
activity on LoadLink's Canadian spot markets hit record levels in February following the border blockades. Has the market settled down since?
It's a good question for you, Dan.
Yes.
Yeah. It's been an interesting 16 months. Let's put it that way. Whether it be Canadian companies importing from overseas, or actually, it's interesting you guys were talking about flatbeds, because that's a topic I wanted to talk about for a latest customer that we're working on. But has it settled down a little bit? The Canadian market, from Canadian brokers' standpoint, the majority of Canadian brokers handle inbound freight from the U.S. with Canadian carriers that haul U.S. customers freight north, right? Majority of carriers in Canada, and I don't know what the exact numbers are, but the majority of carriers have their own kind of in-house outbound accounts that get them where they need to go. The market in Canada has been fluctuating like crazy. So this one customer that I decided to bring to the table today, we're looking at probably somewhere around 35, 40 loads a week inbound from Michigan, all flatbed. And we quoted this customer out 5 weeks ago, actually, as we sit today. And customer came back last week on Thursday and said, hey, listen, we're ready to go. The project's a go. We said, okay, we're going to have to requote because everything's changing. So and full disclosure, with an 18% margin, our rates now cost to supplier are $300 to $500 higher per lane after our initial 17% was already on. So what I did is I went back. So we're talking and the fluctuation is huge. So as you go east of the GTA, it gets way more expensive. As you go kind of west of the GTA, it gets way more expensive. So even if you're stopping in Windsor, you're paying suppliers to the GTA. And so what we found was the process, I guess, if you will, is I went back to the customer and I said, listen, this is a huge amount of volume. You got to think, right? 35, 40 loads a week at, call it a 500% increase. Plus, there's my margin. Call a spade, be authentic, be true. I need a minimum of 12% in order to make it happen. So I went back to the customer, because when we're talking rates like that, that's grounds for customers to say, go take a long walk off a short pier kind of thing if you don't have a relationship. And went back to the customer. Now, I'll give you some history. I've dealt with this customer for 5 years. When this customer was at another company, we helped them achieve goals they hadn't achieved in about 7 or 8 years. So there's a huge trust factor there. And when I told him the numbers, he was like, come on, Dan. Even after all that time, that disbelief of the increase was huge. But when we're speaking to our suppliers, they're saying, it's just, you're talking 35, 40 trucks a week. So we're literally not pulling from a pool like this. We're pulling from a pool like this. So we have to compensate for that, right? And, the blockades, the shortages of getting equipment off the lines, the everything, drivers moving from companies to companies because they want a bigger one-time signing bonus. All of these things come into play when it comes to the U.S. Canadian market. Because as a Canadian broker, especially when I first got in the industry, it was get backhauls, right? As if backhauls are cheaper than head hauls. A mile's a mile. But it's crazy because the Canadian carriers have to be in the U.S. to pick up your freight to come home. But there's another side to it as well, is suppliers. So in preparation for today's call, I called one of the largest, a friend of mine that's very high up at one of the largest paint manufacturers in the world. And he's saying, Dan, we have changed suppliers about 7 times this year, only because suppliers can't get the dye colors that we need, that we used to get, because they're having supply chain issues. So not only is it border issues, not only is it, you look up in Winnipeg and the freak snowstorm we had. My dad's up in Wawa. He's been there for almost a week and a half because he can't get past Winnipeg to go west. He says that you wouldn't believe the amount of trucks that are lined up at the Ontario-Manitoba border. He goes, it is insane, Dan. He goes, I've never seen something like it. So you have that. You have all these other things. But then you have something interesting when it comes to the Canadian market specific for trucks going southern to the US. Canadian companies are sourcing product from different places. US companies are sourcing product from different Canadian companies. So what we're finding is the freight patterns are shifting. So a company that used to do, 10 trucks a week to Tennessee, now their customer is no longer buying from Ontario, they're buying from BC because they just can't find the product in Ontario. So that carrier has lost 10 trucks a week. Nothing to do with themselves, like nothing to do with service, with value, with anything they bring to the table. It's just supply and demand. It's the logistics of logistics. And it's actually crazy to see how things have shifted and where markets are turning. I've got suppliers and customers calling me saying, hey, listen, we used to deal with this one supplier. Do you know anybody out in this area? And I'm like, sure I do. And you're making these, and I'm finding more and more people are asking for these connections. Yeah. So, the Canadian market is just as volatile as the US market. And a lot of the times the Canadian market follows the US market. One thing that's a little less volatile in Canada is the LTL distribution across Canada. It'd be interesting if DAT had some numbers on that, but some of the people that I spoke to, prior to getting on the call were like, Dan, we're seeing a slight kind of downtick in volumes. Could be because people are sourcing stuff elsewhere, but there's not that massive fluctuation shift in costing is what I was told.
Right. Dan, I had a look in RateView this morning at one of those lanes. We've been tracking cross-border lanes from the February, mask mandate blockades. And of course, now we've just had protests and blockades on the southern border. That lane that you and I have been tracking on your weekly sales chatter show is Laredo to Toronto, right? That's what I call Auto Alley.
Automotive Alley.
You remember when we did this story a little while ago, of the 60 Canadian auto parts manufacturers, they had 120 plants in Mexico. So there's a lot of cross-border freight. Right? But on that lane, rates are up to $3.22 today. That's excluding fuel. Now, remember, $3.22 is more than double the average of all of last year. So rates have gone up almost $1.50 a mile in the last few months and not showing any sign of falling off. And I wonder if the different sourcing of parts in the US is part of that story we covered last week about Huntington, where Huntington's one of its biggest exporters is Canada. And on that particular lane out of Huntington, long-term average is about $2.25. It's at $4.56 today, excluding fuel. So it's more than doubled in the last few weeks, or last 6 weeks, actually. So lots of volatility for loads heading north. Do you think that's part of it? The rate,
yes.
We've just seen this massive disconnect.
Yeah. And here's the big thing when it comes to these locations, right? When it's hell to get out of, you're going to pay more, but you're also going to pay more going in. Because they account for it, right? And then you add fuel, so you add 32% fuel on top of those rates. It starts to become a very expensive lane. I recently just actually what are we now today? What are we today? We're Tuesday. So on Thursday last week, I finally got my truck that I ordered a year and a half ago. Finally got it, right? And so it's funny because when I was sitting on Wednesday afternoon, when I was sitting at the dealership, my salesperson looks at me and he goes, you got a killer deal. And I go, I don't really feel like that, to be honest with you, because I don't. I'll be complete transparency. I go, I don't feel like that. I go, because like 2 years ago, this truck wouldn't. He goes, no, Dan, the F-150s have gone up almost $9,000 in the last 6 months. Now, base MSRP. Then you start adding all the other extras. And he said, so for example, he goes like the 502A package, which is like this sports package that gives you a few little newer, cool things in the truck. He says, that used to be $1,500, it's now $1,900. He said, so we're only talking base MSRP. So if you just wanted a base XLT F-150, because it's gone up almost $9,000. And I said, well, what is it from? And he says, it's all logistics, Dan. Every single increase is come down to logistics. He goes, from what I understand, transistor chips are an issue, but not really an issue because there's less people buying new cars, right? We're seeing from what now, again, this is from what he was saying. He says, we're seeing a shift where people are keeping their cars longer because a lot of people are still working from home. So they don't necessarily need that new vehicle to get to and from work. Which was my case because I was like, when my truck didn't come in, he's like, you can get this truck. I'm like, no, I'll wait. Because I do, I do a total
Yes.
of 400 kilometers a month now instead of
Right.
400 a day. You know what I mean? So it's like, but go for it.
There, Dan, I was on a webinar last week with a big battery manufacturer, and one of the things that got my attention was the supply chain disruptions and the port imbalances, and just moving things out of port exports mostly. Instead of Los Angeles exporting direct to Europe, they were trucking their batteries to Montreal, and of course Montreal works when the St. Lawrence Seaway isn't frozen. So that was a great option to then put the batteries on in a 20-foot container and then ship them all the way over into the Mediterranean. But I just wondering, are you seeing anything, before we get into our questions, Ned, are you seeing anything on the import side where shippers are looking to pull forward some of that inventory for later this year into the Ontario market?
Yeah, 100. Well, I mean, I could tell you, my bedsheet customer is bringing containers in hot and heavy.
Right.
Like nonstop. Oh yeah, already. And I'm seeing more and more and more. I'm like, it used to be once every 2 weeks. Now I'm seeing once every 3.5 or every 3.5 days. I'm getting invoices left, right, and center. More containers coming in. I think everybody is. I mean, I've got one customer out in Wisconsin that deals in the Canadian market as well, and they've got an office in Calgary. And even in Calgary, they got 600,000 square feet of additional warehouse space they never had before, and they got 1 million square feet in the U.S. that they never had before, because they need inventory. Now, they do no manufacturing in the U.S. They import everything from overseas, so they're susceptible to when Shanghai went down, when all this, like they just literally get cut off. So he's like, I can't because, and here's a thought for everybody out there. Is I think customers at this point are fed up. Right. Like we understand, 2020, 2021, we get into these supply chain issues, but it's at this point, from a broker perspective, from a carrier perspective, if you're not set up to mitigate some of the challenges that we face, I have a feeling you're going to be left behind, because as much as it's a logistical problem, it's a, at what point in time are people going to say enough's enough? I count on you, the logistics professional, to keep me out of hot water. Right. Do your job. And not to put it in such a blunt way, but, in speaking with my good friend of mine that's very high up at the paint company, he goes, Dan, I'm done. This is what we need. You figure it out. And this is literally what he's doing, and good or bad, he's doing to his suppliers. Listen, this is what we paid you under our contract. You figure it out. I've got logistical issues of my own because I'm a multi-billion-dollar company. I ship freight everywhere, both raw products and finished goods everywhere. I've got my own logistical issues. You figure yours out and come to me with the solution. And this is what I see as 2022 is the year of enough with the excuse. And as much as there's legit problems, but it's excuses in the end. I'll just go back to my truck example. My truck was on the train that got derailed, and Ford lost, I don't know if you guys know, Ford lost close to 1,900 F-150s last year. First they had the transistor chip issue. Then they have 2 containers of transistor chips on the boat that sank when it hit the chemical tanker. So there's those issues. Then they get the transistors. Then they get a truck. Then they get an entire thing derailed. So and here's the thing, what did Ford do? When I got my truck now, they said, we're very sorry. We're giving you this truck at the 2020 price. Not only that, we're going to give you an extra $2,700 off just for your patience. So there was no question. I didn't have to sit there and get frustrated and argue with my salesperson, who his hands are tied. What is he going to do? He can't put an F-150 on his back and walk it up from wherever. It's not happening. But it's what are we as corporations doing to mitigate the challenges that our customers go through? And, Dean, this show in particular, for everyone watching and listening, pay attention to the data, because that data is gold in today's market. And Dean, when you and I first met in 2019, when you said data is the new oil, like, brother, I was a fan for life, man, at that point. You know what I mean? It was like, oh my gosh, yes. When I went to my customer and showed him when we were coming out of Michigan for the flatbeds, I literally took a map of Michigan, and through the conversations, I figured out the area that we're pulling trucks from. And I went in and I actually created just a simple PowerPoint. And it was just a 1 page that I turned into a PDF. Like, it wasn't a death by PowerPoint. And I had the map and I had the original location. I said, originally, this is the area we had to pull trucks from. Now we're pulling trucks from this location. I gave him a visual. of what the data told us about what trucks were there, where we would have to pull from to facilitate the account. That's the big differentiating factor. Sure, somebody could give you a rate, but when it comes time to get trucks to keep you out of hot water, to increase your image, your credibility, and your brand in your company as a traffic manager, logistics manager, operations manager, whatever the title is you have, there's a difference between facilitating it with excellence and just calling a rate. Right? We all know that. We've been in the industry long enough. Yeah. And when I showed him that.
Yeah, I was just going to say we're running up on time, Dan, but we could probably talk all day about this stuff. I'll be on your show tomorrow morning. But Ned, we've got a couple of questions. And
yes, we do.
Long-time listener.
We do. A long-time listener. I think it's Dean Catamo, a long-time listener, first-time caller. Do you see any evidence that flatbed rates will break out of their holding pattern sometime this spring?
Yeah, definitely. I mean, think about commodity prices, right? They're pretty high. Farmers are going to be buying a lot of machinery. We've got more steel moving, more construction, infrastructure bill. I think they'll break out of this pattern pretty quickly. As to how high they go, I'm not sure. There is some resistance at current levels and a little bit of downward movement this time around, but I think they'll break out of that pattern and continue to rise.
I mean, just to ask questions, and I'm not sure that this is right. If flatbed and reefer rates keep dropping the way they are, even if it's difficult for carriers to make the shift over to the flatbed market, if you're seeing like 70, 80, 90, $1 worth of difference between flatbed and will people make the switch? Yep. And that would drive down rates.
Already seen guys I know drop their vans and get under their old flatbeds they've got sitting out in the weeds. So,
but here's another thing on that though. If you're planning on doing that, I have a very good friend of mine that did flatbed for years. He said, Dan, 8 out of 10 people driving flatbeds have no idea how to ride flatbeds. It's not a dry van. It's not a
hard work.
The securing of freight, the understanding where things get bracketed, where things get mounted, like where braces go on, where chains go on. A different world.
You've got to have a whole lot of stuff just to tie a load down. We've got one more question, Ned.
Yes, Hunter Mathis asks, with rates falling as quickly as they are, do you see for the market having a similar rebound as it did in 2020 and 2021?
That's a great question. We don't know that we'll see a material impact in terms of rates going up in dry van and reefer, but we still haven't seen the bottom yet. So, Hunter, I'm not sure we can call this because rates are still going down even as we go on air this morning. So we need to see what happens for the rest of the week, but it looks like we haven't hit bottom yet to make that call about if there's a rebound and by how much.
I mean, rates are cyclical, so you do expect at least some amount of a bounce when you hit the bottom. It's just I'm familiar with the term dead cat bounce, where it hits and then it doesn't really come back up. It just sort of skids along the bottom.
Well, that's why
I think you're going to have a dead cat with one last breath bounce. And the only reason I say that, gentlemen, is because driver wages have gone up, cost of equipment has gone up. There has to be a balance for that. And as a carrier, if you're not balancing for that, you're in a lot of trouble. And Dean, we talked about that 25-33% of spot rates when that impacts fuel. I hope carriers learned from 2018 into 19. I really, really hope they did, because it unfortunately, it's us that do it, gentlemen. Call us spade a spade. It's brokers and carriers trying to fight for the almighty profit, the almighty dollar, not thinking of long term, thinking of short term. How am I going to cut that throat to save my neck? But and we do it to ourselves. You know, we allow customers who say, "Hey, Dan, I'm going to pay $950 from Toronto to Chicago." And I go, $950? He said, yeah. When did you do that? Oh, 2 years ago, I got it for that rate. I go, okay, well, that doesn't work. And then, but somebody needs, and that's a big quotation, needs to get to Chicago. So they're going to take the load for $950. Now what you've done is you've set a precedent with that customer that everything's $950. So, and just somebody will take it because they might be getting $6 out of Chicago. So they think, a $950 down at 700 something miles. So you're $1.80 a mile with a $9 return and a 3-day down and a waiting at dock for 9 hours and all this other stuff that goes along with it is a good ROI. But you're leaving a wake of destruction for everyone else.
Yep.
Yeah.
You know,
We'll see. Dan, on that note, we have to wrap up. But Dan,
yes.
talk to us about your show. I'll be on tomorrow
Yes.
morning, Data Wednesday. Give us a
Yes.
quick update. How can people find you?
So you can find me on LinkedIn, Dan Deegan. You can send me an email, info@dandeegan.com, and it's DEIGAN. We host a live show every day, 9 to 9:30 a.m. It's called Sales Chatter. We talk about sales strategy, tactics. On Wednesday, the Dean himself, the mad scientist of data, Dean is on with us every Wednesday. And we take Dean's data and we teach you how to sell with the data and how to really be that true resource to your customer. You know, my co-host DJ Flores and I, we started this as the idea that we want every salesperson in this industry to wake up on a high note and just take that, rev that RPM to the max before you start your day. My mission is to help 10,000 sales reps generate over $1 million GP, and doing it through not robbing people, but doing it through being a resource and helping build image, credibility, and brand.
Yeah. All right. Thanks, Dan. I'll be on tomorrow morning. I'll talk to you then.
Looking forward to it.
Yeah, can't wait. Thanks for being on today.
Remember,
we'll also be on Landline now tomorrow night at 7 p.m. Eastern. Ned, what other shout outs have we got? Anything else this week?
I don't think there's anything else right now.
Yeah. All right. Yeah. Okay. So that's it for this week. Remember, our long form market update is at dat.com/market update. You can find us there. If you've got any questions, shoot us a note at askiq@dat.com. We'll do our best to answer all of your questions. And with that, we'll bring our show to a close and talk to you next Tuesday at 10 a.m. Eastern. Have a great week, everybody.
Bye all.
Take care, everybody. Thanks for having me, guys.